let me give you a model, a 4-quadrant magic quadrant model. I think that I'll start with the observation, cryptocurrencies mostly aren't currencies at all. Cryptocurrency is a misnomer and it creates massive confusion. And I think people in the space are confused. I think people out of the space are confused. And I think a lot of people that speculate in it, they speculate just in these things without having a long-term thesis about what they're doing. Here's the way I would segment the space. 4 quadrants. You have digital property. Bitcoin is the king of digital property. It's optimized for integrity and durability over long periods of time. The idea is I want to take $1 million, buy Bitcoin, and I want to hold it 100 years, maybe 1,000 years. Imagine owning a city block in London. Your family owns it 300 years ago. When would you ever sell it? Never. Do you want to sell it? No. How are you going to live? You're going to generate yield on it through rent by lending it out to someone else to build a building on, or you're going to finance it and you're going to borrow against it. How long can you do that? You can do that forever if you're actually a smart landlord. It's not a currency. If you owned 10 city blocks in London, and I think like the Duke of Wales owns, parts of London. You probably know the history. A lot of the land doesn't trade hands. If you own 10 city blocks in New York City, your family might keep them for 300 years. If the Fed keeps printing 10% more money a year, you can expect your land will go up by 10% a year because it's scarce, it's desirable. You can continually refinance it. When you have $1 billion of it, it goes up by 10% this year. And then you have 1.1 billion and you borrow 50 million at 3% interest, and you have no capital gains tax, you have no income tax. It's a simple business. That's digital property. Digital currencies are Tether, DAI, Circle, DM will be a digital currency, a CBDC. That's a digital asset that's seeking to be a stable currency, and it's a medium of exchange. If you want a high-speed, decentralized medium of exchange where you can move $50 million from Zimbabwe to Emirates on Saturday afternoon, outside of the Fed wire, outside of ACH, outside the banking system. If you want to give everybody in El Salvador $37 on their mobile phone, you got to do it with a digital currency. So this is not a subtle thing. It's 8 billion people need a currency. The currency is the medium of exchange. The property is the store of value. Now, the third quadrant is a digital platform, Ethereum. It's a platform. They want to create a platform where you can create applications like a decentralized exchange, an insurance company, NFTs. Decentralized applications is their mission, but they are a platform for it. When you buy a ETH, you're buying an asset token, a digital asset that gives you a share in that digital platform. And then the fourth quadrant is digital or decentralized applications, Uniswap. Right? They're trying to replace NASDAQ or Coinbase, or Binance Smart Chain wants to replace Binance, a centralized exchange. So here, looking at the picture behind you, I give your family $1 billion and I say, you can either buy $1 billion of land in London, or you can buy $1 billion worth of buildings in London, or you can buy $1 billion worth of the British pound, or you can buy $1 billion worth of companies in those buildings. Okay? The British pound is the digital currency, the land is the digital property, the buildings are the digital platform, the companies are the digital applications. You understand the upside, the downside, and the risk profiles of each of those four? See, the land will probably be here for 500 years, right?
Absolutely.
Right? The building's probably got a useful life of 50 years to 100 years max.
Hey, in the background there are some buildings that are around 500, 600, 700 years, yes? But
maybe some.
Yeah.
And then there'll be like
church, for example.
Yeah, so it might, by the way, some might last hundreds of years.
Yes.
And then there'll be like the some where they'll take it down because it's no longer competitive. How about the companies? Name a company in London that's been around for 100 years.
Oh, most of them are gone, right? I mean, that's the cycle of life.
So that's the best way to understand the crypto economy, right? The digital currencies have to be compliant and compatible. They have regulatory risk. There's not a lot of upside to owning those, by the way, but you need them as a medium of exchange. If you want to trade in and out of them, you got to have them to lubricate trading and DeFi, and you also need them to buy coffee. In El Salvador, they want the digital dollar to buy stuff with, but they want the digital asset, the Bitcoin, as a long-term store of value. Think savings account, checking account, or think in terms of working capital that I need in the next 12 months versus corporate treasury that I need to hold 100 years. Balance sheet.
Okay, then I have to.
Does that help in terms of a segment? And do you have a reaction to that?
It comes back obviously to the argument of store of value, right? And obviously we are in a period now, coming back to what I said earlier about the general liquidity wave. So one particular question I have or want to raise is an article I wrote a couple of months ago, which to me, the argument that it's an inflation hedge and a store of value is at the moment a bit unproven. I know obviously we are from massively up in the curve in terms of where Bitcoin used to be in terms of price, and I have to say, given everything that's been thrown at it lately with China, UK, and everybody else trying to, and we can talk about the regulatory side some more separately, but it's kind of holding there above 30,000 right now. So it's taking some hits, but it's still massively up. But, and I'll bring this to you, I put out this chart out a few months ago, and I updated it recently. If you look back the last 4 or 5 years, what did we really have? We had the first big liquidity run was the US tax cuts. That was 2017 into 2018. Both stocks and Bitcoin rallied hard, right? Then we had a correction. And by the way, the correlation was like 90%. It was amazing to see this just on a weekly chart. I mean, just the capital flow, everything flew in. Then stocks corrected, Bitcoin corrected. Then there was another rally, but then we had that event. It was the year where the liquidity basically dried up, right? It's when we had quantitative tightening, the interest rate raised, 10-year hit 3.2%. Both Bitcoin and stocks went down. When did they bottom? They bottomed exactly basically at the same time when Jay Powell flipped, and they went back into cutting rates in 2019, and they expanded their balance sheet, and everything rallied back up right up until February 2020. We had COVID, everything went back down. And now obviously with unlimited QE, everything went back up. So basically what I say is, and the other point I'll make here is, by the way, in 2017, Bitcoin peaked first, then the S&P peaked later. We had the same thing in 2019. Now we have a decoupling again. My point being is that in terms of liquidity flow, as long as assets keep elevating across the board with stocks and the Fed and the ECB continuing to print, I can make the argument, yes, crypto assets going to keep flying up. This year, we even had the additional impact from fiscal stimulus, right? We got all these checks coming out and people speculating on all this stuff. What we haven't seen at all, because the world hasn't seen this in a long time, is what happens if actually the liquidity equation stops, in the sense it does not elevate asset prices any higher. My concern is that what we're seeing in general right now with valuations in stock markets disconnected from this actual size of the economy like we've never seen before, we don't know. We have no evidence for what happens if we actually get a right sizing, if you will, a rebalancing of some sort. How will Bitcoin or other cryptocurrencies act as a hedge? Because to me, that's still unproven. That's kind of one concern I have, because obviously we're still high, but everything's high, right? Obviously, cryptocurrencies have benefited more than anything else because of and by the way, and just general saying, I've been tracking Bitcoin in particular from a technical perspective on my Twitter feed. And I love it from one perspective, from two perspectives actually. One is it acts very technically. I can chart patterns, I can see correlations. It works beautifully. And the second aspect of it, it actually trades like a free market vehicle, you know, because these stock markets right now, they're disintegrated into a balance sheet tracker of the of the Fed. They have no volatility whatsoever. As a trader, I appreciate the volatility and I appreciate the technicals of it. So from that perspective, I like it. But I'm just saying, in terms of the global liquidity influence, my concern is that this hedge argument is unproven, and if we actually do go back into a corrective mode in markets, how much that will impact these currencies. I don't know the answer to that.
Yeah, so my view on that is if you pull in your time frame to less than a year, less than 12 months, and you consider, regulatory uncertainty and market liquidity crisis, like just about anything can happen. And we just saw an example with the China exodus, with a major shock, which drives a lot of people had to forcibly liquidate their holdings in China. If you look at it, it was a crackdown not just on Bitcoin mining, it's a crackdown on Bitcoin holding and the ownership of it. So you can see things like that, and you can see that ripple through all the leverage in the crypto markets. That's why I think trading it and speculating it are really difficult. I come at it a different way. I mean, I think you can look at it from first principles. You can say, what's the most popular monetary asset in the world? The dollar. What's the second? The euro. What's the third? The third is Bitcoin. So of the top three, the only one that's going to go up in value as we print more money is Bitcoin.